Welcome to part two of the Value Add Commercial Property course. Now, if you're interested in learning how to find, fund, and finish commercial value add opportunities, then this course is for you. Today's part two, we're focusing on rental reversion strategy, and it's going to be one of the most fundamental strategies that you could apply for a value add opportunity. Now, if you haven't watched part one, please watch part one straight away before you watch part two, because part one is going to give you the foundational knowledge that you would need in order for you to make sense of these value add opportunities. So I've put a link of the video above here, so please go watch part one first. Otherwise, please enjoy this 2-hour masterclass, which is part two of the 6-part value add commercial property course. All right, so I think let's get started. Let's get right into it. Now, guys, just a bit of housekeeping. Really appreciate it if you guys mute your microphones unless you guys are asking a question, because sometimes phones go off in the background and things like that. So I really appreciate it if you guys mute your microphones unless you guys are asking a question. And then the other thing also is that for those of you guys who are not camera shy, I really encourage you guys to switch on the camera, because I realized last time when I was asking questions, I couldn't see people's reactions. So I really love to be able to see people's reactions. People put up their hand, when I'm asking questions. So hopefully some of you guys like Eugene and Tim, Flo, if you guys are not too camera shy, please switch on your cameras. That would be really, really good. Yeah, thanks guys. Yeah, I can start seeing a few of your faces. Perfect. Yes, Elias, yes, this will be recorded and I will be sharing the replay with everybody later on. But obviously, like I said earlier, the more you guys can participate live, the better it is, because I really encourage you guys to ask questions. Because the more questions you guys ask, the better this session will be, because I might forget to say something or someone else might have questions that you didn't think of, all those type of things. So really encourage questions. We're going to keep it pretty dynamic. And yeah, so let's get into it. So who's ready? Who's excited? Who's got pen and paper ready to go? Yeah? Excellent. Excellent. All right. Okay. So quick disclaimer, again, this is not a property development course. Okay, so we're only focusing on how to add value to established assets. And again, nothing in this course is financial advice. It's just financial opinion. And I'm just sharing with you guys what I've done in the past. Okay, so can I please ask everyone to have their microphones muted? Unless you're asking a question. Yeah. All right, beautiful. Okay, so I want to start off by talking about mixed martial arts. Okay, so who's watched mixed martial arts? Hands up. Who's watched mixed martial arts? Yeah. So who guys like mixed martial arts? Okay, quite a few of you. Not for everybody. The reason I bring it up is because commercial properties is a little bit like mixed martial arts. Yeah, it's not like a single sport where it's just karate or just judo or just taekwondo. You have to know a little bit about everything, because as soon as you get into the octagon with someone and you're fighting with someone, if you don't know how to grapple, you don't know how to throw punches, you don't know the mixed martial arts type of things, you're going to get hit in the face and you're probably going to get knocked out. Likewise with commercial properties, you have to be a mixed martial artist. You have to know all elements of the sport. So that's why we're going through 5 main strategies throughout this course, so that you guys are not going to be, a one-trick pony or anything like that. With residential, it's very straightforward. It's just one way to do it. With commercial properties, not. There are so many ways to do it. So just a quick recap of session 1. So we talked about the deal flow triangle. So in order for you, and this is speaking from experience, in order for you to get that one deal that's going to make you hundreds of thousands or millions of dollars, you have to start off with probably triaging 1,000 properties. So we went through that during the first session, so I'm not going to go into detail. And then the other thing also is how do we find opportunities? Okay, so there's the outbound component and there's also an inbound component as well. So the outbound component is all about you doing the heavy lifting. So you're looking for opportunities online, you're calling agents, you're networking, but we should all try to aspire to get more inbound opportunities. So inbound opportunities are people that are coming to you. So agents coming to you saying, um, hey, Will, look, I've got this opportunity that's going to really suit you because you and I have done a deal together in the past. I know exactly what you're looking for. This is perfect for you. You also want inbound opportunities from business partners and from brokers as well. Also, starting with the end in mind. This is really, really important. And I talked about this during session one, is that 80% of property investors make this mistake is they don't know where they're actually heading. Because they don't start with the end in mind. So it's really important that you figure out what it is that you want to achieve through commercial property investing. And these are, some of the questions that you should be asking yourself. Like I asked you guys to do the homework. So who actually went through this exercise over the last 2 weeks? Just show of hands. Yeah, Isabel, great. Dennis, great. I can't see some of the other faces, but I assume a few other of you guys have done it as well. So which is really important. And look, this might take a day, this might take 2 days, this might 2 weeks, but it's really important that you guys establish these, ask yourself these questions, because it's going to lay the foundations to how you're going to invest. Not what, but how, which is probably more important than what you're going to invest. And then finally, the outcome of this course is you're going to learn how to find these opportunities, how to fund it, and how to finish it. All right, so that's just a quick recap. Okay, so let's get right into it. So today's session is all about rental reversion strategy. So who's heard of rental reversion before? Hands up. Yep, cool, quite a few of you. Okay, so rental reversion is basically identifying a misalignment in rent and applying a market review to a lease or property that's previously under rented due to market movement or other factors such as rezoning. So I give you one quick example. So we've all just lived through COVID and obviously the pandemic and all the lockdowns and things like that. What has happened since the pandemic is that a lot of money was printed all across the world, and all that money went somewhere, and a lot of it went to assets. And so you see a lot of asset prices actually, shoot up during that sort of period. And then at the same time, we're seeing a lot of different business sectors also boom as well. There's a lot of business went down, but a lot of business also went up. What that means to commercial property is that a lot of assets, particularly in the industrial space, rents have gone up. A lot of places rents have doubled over the last 4 years. So you're finding yourself with tenants that might have signed a lease before COVID. So we call them pre-COVID leases. And fast forward to today, those rents have gone up, 50, 60, 70, 100%. But they're still locked into the pre-COVID rates. So when the time comes when their lease expires, they're going to be hit with a market review. So what we want to do as an investor is identify these properties with tenants that are currently paying under market rent. And there's a lot of reasons why that would happen. Like COVID is a really good example. So people who signed at least 5 years ago, maybe they're paying $100 a square meter. Now the market's at $180 per square meter. That's a really good uplift potential. And there's also other factors like rezoning. So maybe there's a property that was previously zoned as, let's say, just recreational use. So it's very limited to what type of tenant can go in there. But all of a sudden it's got rezoned into, let's say, a district center or a different type of zoning. All of a sudden, that particular asset can attract a wider range of tenants. So the rents would go up. So there's a number of factors which kind of contributes to this. So what we're trying to do is trying to find properties that are under rented, basically. So just a quick illustration. So we talked about this story during session one. So which is a really good example of how this kind of works. So just to recap, so my client bought this about 18 months ago for $3.25 million. At the time, the tenant was paying $250,000 per annum in net rent, which is about 8% net. Had 2 years remaining in the lease, but we knew that what they were paying was under market rent. So fast forward to today, we've actually renewed the lease. We've increased the rent by 30% to $325,000. They've signed a brand new 10-year lease. And because of the increase in rent and the extension of the lease, a new valuation was done at just under $4.5 million. So that's about $1.1 million valuation uplift. And the great thing about rental reversion strategies is that it doesn't require necessarily any construction, any DA. It's probably the out of the 5 strategies we're going to cover is the one with the lowest risks. Okay. Okay, so moving on, in order for you guys to execute on the rental reversion strategy well, you have to have a really good understanding of the following 4 things. Number 1, cap rates. Number 2, incentives. Number 3, rental reviews. And number 4, WALE. Okay, so I covered this in the 101 masterclass, which I hope you guys have watched. If not, I'll briefly go through what they mean. Okay, so why is cap rate important? Because cap rate is what most investors and valuers use to value a property. And what a cap rate basically means is what is the expected rate of return on a particular property. And that's usually reflected or usually explained as a net yield basis. So as an example, let's say the average net yield for industrial properties in Brisbane Metro is 6%. Then we can probably adopt that the cap rate for industrial properties in Brisbane Metro is 6%. Now, why does cap rate fluctuate? Because between assets and between locations and between tenants and things like that. Because cap rate is basically a function of what the perceived risk is associated with an investment. Excuse me. So even if you look at equity, you look at stocks, they also talk about cap rates. So cap rates, whether it's 5%, 8%, 10%, is usually a reflection of the risk associated with the investment. So obviously, if you are an investor and you've been presented with an opportunity that you think is pretty low risk, then you're probably willing to accept a lower cap rate, as in a lower net return. On the other side, if you're presented with an opportunity where you think it's probably a little riskier, then you will probably expect a higher cap rate or higher net return. Does that make sense? Any questions so far? So feel free to ask questions at any time. So what are some of the things that influences cap rate? So, I just explained cap rate is basically a measure of the expected return, but is also a reflection of the perceived risk on an asset. So you've got macro influences and you've got micro influences that could affect cap rate. So some of the macro influences will be obviously the market movement. So where's the money going? Are people favoring stocks at the moment, or people favoring commercial property at the moment, or people investing in businesses? Like, where's the market? So market is a big influence over cap rate. Cost of funding is another one. So if your cost of funding goes up, then obviously you need a higher cap rate to compensate, your cost of funding. Interest rates is one thing that influences cost of funding. And there's bunch of other factors as well, such as new infrastructure spending, development opportunities in the region, and so forth. And then you've got micro influences, which are a little bit more property specific. So the macro influences are more economy specific. Micro influences are more property specific. So one of the things that would affect cap rate is the quality of the tenant. Are they an A, a AAA rated tenant business or a B rated tenant? What is the WALE? So the weighted average lease expiry. So how long do I have secured income coming in from this investment? Obviously the location, is it metro? Is it regional? The build quality of the actual building, etc. So there's a number of micro influences that affects the cap rate. So just as a couple of examples, and feel free to unmute because I want you guys to answer this question. So if you were presented with two identical properties, but one of them only has a 2-year WALE versus another one that's got a 5-year WALE, which one do you think would have a lower cap rate? Anybody? Excellent. Excellent. That's because it has a longer secured income. So you're happy to, get a slightly lower rate of return initially. All right, question number 2. Again, guys, I love your answers. If you, again, presented with exactly the same property, one is leased to a government department, let's say Centrelink, whatever, and then the other one's leased to a stock exchange listed company, ASX listed company. Which one do you think would have a lower cap rate?
I would say the government.
Government. Yep. You will probably be right. Because the government, even though an ASX listed company is high quality, the government ultimately, well, particularly the Australian government anyway, is going to have a AAA rating. And then last question, let's say you had a similar property once in Sydney Metro and then once in regional New South Wales. Which one would have a lower cap rate?
Metro.
Yep, I think you'll probably be right most of the time as well, because Sydney Metro would be perceived as a lower risk location because there's bigger population, more demand, etc., etc. But that's not always the case. Okay, you're probably right 90% of the time, but that's not always the case. So it's really important that you look at deals on a case-by-case scenario. But generally speaking, you're right. So these are some of the things that affect cap rate. And why am I talking about cap rate? Is because at the end of the day, you want to be able to increase the rental income of the property, and also calculate what the cap rate could be to determine what the end value is. So we'll run through a few fee zones later on, so to illustrate this point. Okay, number 2. This is a really, really important topic, so you guys really need to pay attention.
Ask a question.
Yes.
So it's Eugene here. Just a question, just going back to the slide, the example 2, government versus ASX listed.
Yep.
Governments, my understanding is that sometimes government departments can be funded or like their funding can be removed after a certain number of years, especially when the government changes. So how does that impact the risk of a government tenant?
That's a really good question. So let's talk about NDIS as an example. That's not exactly government department, but that's a government funded program. And there's been talks about government removing funding from NDIS and all that type of stuff. But the thing is, once a government signs the lease, they're locked in to the lease. So they're obliged to fulfill their obligations in the lease. So the only thing that we can count is what's in the lease. Now, your question is probably more directed towards what are the chances of them moving out of the property?
Yeah.
Yeah, so that's something that you need to assess on a case-by-case scenario. But if everything is the same, there's no funding being pulled and everything is basically on the same level playing field, the government is typically deemed as a less riskier enterprise. given the nature of it. But like I said, if they've signed a lease, they will be obliged to, fulfill the requirements of the lease. So as an example, if they've signed a 5-year lease, their funding gets pulled after 2 years, they would have to pay out the remainder of the lease.
Okay.
Yeah, so you're protected regardless. So that's why government tenants are always deemed as, it's in Australia anyway, deemed as, the best type of tenant you can have.
Okay.
Yeah, cool.
Can I ask a question? It's
Yep.
Isabel.
Yep.
Yeah, this is just more from your view. Um, most of the sites we look at the yields and the cap rates, but sometimes by having a lower or shorter period lease, as we know, owner occupiers may potentially have deeper pockets in certain locations. Are you seeing that gap actually closing, or is that still going to be the play in certain markets?
So the question is there a difference between what an owner occupier will pay and an investor will pay? Is that this question?
Yeah. Because certain locations we've been looking at, essentially the site would be worth a lot more if it was to be purchased by an owner occupiers versus if it is tenanted. So are you seeing, that trend continue, or is that just in certain parts of, the eastern border?
Yeah, that's a really good question, and I'm going to cover it probably later on in this in today's session. But generally speaking, imagine this: if you own a business and you want to make sure the business stays around for a long, long time, then typically you want to buy a place so you can house your business in. So your motivation and your sort of decision-making process will be different to an investor. So an investor, a pure investor, I should say, would only look at the numbers, whether it's profitable or not. So by that definition, whatever an investor looks at, they'll look at it with a percentage of profit margin, whereas an owner-occupier might necessarily need a profit margin. So generally speaking, owner-occupiers would still probably pay more than an investor, but again, it's a case-by-case scenario. So the purpose of today is to talk about the rental reversion. So we're probably not going to be touching on owner-occupier scenarios very, very much. That would obviously come probably in some of the other sessions that we're going to cover in the future. But you're right, Isabel. Generally speaking, an owner-occupier will probably pay more than an investor. So if there is an opportunity that presents itself where the WALE is really short, which I'm going to talk about the importance of WALE. The WALE is really short. Let's say it's only 3 months. Then you are potentially competing against owner occupiers because someone can buy it and just wait 3 months and then they can move in. Whereas if you're looking at a property that's got a 2-year WALE, well, that's probably not going to appeal to an owner occupier because they probably don't want to wait 2 years to move in. I mean, some businesses might, but majority might not. But I'm happy to cover that off in a little bit more detail in a couple of slides. So hopefully that answers your question. Excellent. Okay. All right. So I want to talk about incentive, and I'll spend a little bit more time on incentives because this is a really, really important tool to use for rental reversions. So who's heard of incentives in a commercial property deal? Okay, a lot of you guys. Excellent. So basically what an incentive is a tool used by property owners to entice businesses to lease their space. So some of the most common incentives are, rent-free periods, fit-out contributions, lessors works, etc. And that's usually expressed as a percentage of the overall rental commitment. So let's say, for example, you've done a deal with a tenant, you've given them 6 months rent-free, and they've committed to a 60-month lease term, then that's a 10% incentive. Make sense? So likewise, if a tenant committed to a 60-month lease term, but you've only given them 3 months rent-free, then that's 3 divided by 60, that's 5% incentive. Okay? Each market, and each property type would have different incentive levels. Now, incentives is not a fixed rule. You don't have to give an incentive. But sometimes when tenants are shopping around and they're saying, well, if this owner is giving me an incentive, why can't you give me an incentive? Sometimes you kind of just have to meet the market. Now, I want to further explain the difference between an effective rent and a face rent. Let's say, here's a scenario. Let's say there's a tenant that's just agreed to a 5-year lease and paying $100,000 per annum in rent, and the incentive is 10%. Let's say that's still, so you just sign off on that deal. What a face rent means is what the tenant is paying on face value without considering the incentive. So that will be $100,000. An effective rent is taking into consideration the incentive. So it's basically the net value of the rent. So it's basically $100,000 minus 10%. So the effective rent becomes $90,000 instead of $100,000. Why is that important? Because later on, when you start putting these deals together, you need to figure out whether the tenant is paying you a face rent or an effective rent, or whether there's any outstanding incentives that you will be liable, and all those type of things. So it's important to understand the difference.
Will, can I ask a question?
Yes.
When valuers go and value a commercial property, and say, for example, there was an incentive offered to a tenant, do the valuers include the incentives as part of their valuation?
They can. They can. So specifically, if there's excuse me, ongoing incentives, then that would definitely be factored in.
Okay.
Yeah. Cool. Okay, so I want to also explain why incentives are critical to a rental reversion strategy. So I'll give you scenario number one. Scenario one, let's say you have a property, it's vacant, and you're advertising it for $100,000 per annum in rent. Tenant comes along and says, hey, I'll lease this, but I want a 10% discount. So you basically got two options. One is, yeah, no worries, I'll give you 10% discount. Let's just reduce the face rent to $90,000. Or you can say, you know what, I'll give you 10% equivalent in incentives, but the rent stays at $100,000. So fast forward to valuation. When you're evaluating property, let's say this particular property has a 5% cap rate. In scenario number one, because you've discounted the face rent to $90,000, at a 5% cap rate, the valuation comes in at $1.8 million. However, if you offered in scenario two, if you offered the tenant the 10% incentive, but kept the face rent at $100,000, come valuation day, your property is now valued at $2 million. The big difference. Even though you're paying the tenant $10,000 on the side, you're still netting far more than what you would have been netting if you had discounted the rent altogether. Now, usually going back to your question about, does incentives come into play when valuing the property? So this is also depending on how you structure the incentive. I always recommend trying to provide all the incentives upfront. So the incentives is taken care of, so there's no ongoing incentive. So when a valuer comes in, they can't say, hey, look, you still got $50,000 of outstanding incentive. I'm going to deduct that off the valuation. If you're able to provide all that incentive upfront, let's say, Mr. Tenant, Mrs. Tenant, I'll give you that 10% incentive. You just take it up front. I'll just give you 6 months rent free up front. Then at the back end, the incentives have expired. There's no more incentive. So it's not going to affect your valuation. So does that make sense?
Yeah, it does. I'm just wondering as well, like, is it possible to offer incentives to a tenant as like a separate side contract as opposed to in the lease itself?
Yes.
The valuer never sees.
Yes. Yes. So I actually recommend doing that. Yeah.
Okay.
Yeah. So typically what you have the lease, and then you have an incentive deed. And then they obviously they get signed simultaneously, but they're separate. So when you're presenting it to a bank, you could omit the the incentive deed and just provide the lease. Cool.
Hmm.
Okay. Let's talk about scenario number 2, why incentives are critical. So let's say you own a warehouse that's 1,000 square meters, and your motivation is to sell this property in a year's time. So you want to maximize the value as much as possible. Let's say the market rent for a property like this is $200 per square meter, but you want to see whether you can push the envelope a little bit, just a little bit more. So you try to lease the property out for $205 per square meter. But what you do is you're going to give that extra $5 per square meter back to the tenant in a way of incentives. So the difference in valuation, as you can see from the scenario here, is about 100 grand in difference. So even though you're paying an extra $5,000 of incentive, you're getting back 100 grand. Well, actually, it's more like 25,000 because they're typically going to sign a 5-year lease. So it'll be, $5 times 1,000 square meters times 5 years. So 25 grand. So you're offering the tenant 25 grand in incentive to offset the extra $5 in rental payment, but you get back $100,000 in value. So you're netting an extra $75,000 in value. So that's another way of using incentives. So incentives, if you're clever and you're creative and you know how to use it, it is the best tool you're ever going to use. Okay, so all right, before I move on, any questions on incentives?
Hi, Will. Dan here. Just want to check, like, for incentive, do you always give that to the new tenants only, or you may consider that to the existing tenant if there's a ongoing lease?
Yeah, 100%. So this is what you have to weigh out. So you would only have this conversation with an existing tenant if their lease is coming up, right? So they now have the option to either move out or stay.
Yep.
So you kind of have to run this scenario. All right, what is the likelihood of them moving out? Well, the likelihood of them moving out is if they get a better deal somewhere else. But then you also need to consider what is their cost of relocation. Because there's always a cost of relocation, not just the hard costs like moving your equipment and things like that, but you've also got disruption to the business, and maybe you might lose a couple of staff because you're relocating and da. So if you're in a market where a tenant has more options, then you as a landlord, you'll be motivated to provide them with a good incentive to stay, right?
Yep.
Whereas if you're in a market where the market is really tight, the tenant really doesn't have anywhere to go, then you're not motivated to give them any incentive. So you kind of have to look at the market and where that's at. So like as an example, if we look at Club Lime as an example, the story we just told, during this conversation of lease renewal with them, they were obviously trying to get some incentive out of us. like any good tenant, any good business. But we looked around and we said, hey, for you to relocate, there's really only 3 locations you can go to, because gyms can only relocate within a certain geographical boundary. As you guys might know, it's just like a McDonald's, right? They have their own territories. They can't move out of those territories. So they're captured. It's not like they can move from Parramatta, Sydney, to Newcastle. Like that can't happen. They have to stay in a geographical location. So we basically said, look, the likelihood of you moving to those 3 locations is pretty small, because it doesn't really fit all your requirements. The dimensions are not that good. The configuration not good. So at the end, what we did do though, it was say, look, we want to increase your rent by 30%, but we also want to help you with this transition. So we'll offer you $300,000 in incentives. So that all worked out to be less than 10%. And the only reason why we agreed to that is because we actually wanted them to spend the money on the building to make the building look good. Yeah. So hopefully that answers your question.
Yeah, it does. Thanks.
No worries. Any other questions on incentives? Okay, we'll move on. Rental review. So rental review is basically what's the annual increase in the rent, or what the market review is when the lease option becomes available. So the rental reviews, they could be fixed percentages, like 2%, 3%, 4%, 5%. It could be CPI, just inflation, or it could be a hybrid. Maybe it's a 3% or CPI, whichever is higher, or it could be maybe CPI plus 2%, etc. So there's no fixed rule on how you structure the rent, the annual reviews. However, obviously, tenants these days, they're pretty smart. They'll probably go around and see what other people are offering, and most of the time you just have to meet the market. The most common ones is obviously CPI. Majority of leases are on CPIs, but a big percentage of them are also on fixed reviews, like 4% or 5% or 3%, 3.5%. I've seen 3.75%, and I've seen CPI plus 2% or 4%, whichever is higher. Like I've seen all these weird combinations. But what I really want to talk about is market review, okay? Because market review is what is going to make or break the deal. So market review will kick in when the tenant's initial lease term is up, or when there's a trigger for a market review. Very often it happens when the lease expires or when they exercise the option to renew a term. So there's a few sort of scenarios with market reviews. There's obviously the open market review. Basically means that if the rent's gone up, you're gonna pay a higher rent. If the market rent's gone down, you're gonna pay a lower rent. Okay, so whatever the market rent is at that point in time, that's what the tenant needs to pay. So the landlord wears that risk as well. So if the market goes down, then you're gonna bear that. Or the market goes up, you win. However, there's a ratchet clause that you can actually insert into a market review. Basically, what that means is the market review can only go one way. So ratchet, in case you guys don't know what it is basically a tool. It's like a spanner, or what, I don't know, I'm not a mechanic, but it basically just goes one way. So when you're unscrewing something, it just goes one way. So if you had a market review with a ratchet, it means that the rent can only go up. So you as landlord, you get protected. But there's also another thing called a cap and a collar. So cap, wearing a hat, and a collar, putting on your neck, which means that the rent can't go above a certain point, or it can't go below a certain point. So for example, let's say there is a market review with a cap of 10% and a collar of 5%. That means the rent can't go beyond 10% and it can't go below 5% of what they're currently paying. Now, I don't see that very often these days, but there are clever businesses out there, people who know property, they will do that. So there's one example. There's a property in International Drive in Tullamarine in Melbourne. The current tenant, I can't remember the name of the tenant, they're paying only $83 per square meter. The market around there is probably about 150. So we're like, oh wow, this is like really good. So we're triaging this property, and we're like, oh great, their lease is about to expire in 4 months. Wow, let's have a crack at it. And then once we got the lease, we realized they should have a cap. At market review, the rent can't go above 5%. So the landlord who signed this lease, I think, got really bad advice at the time and shot himself in the foot, because he needs to carry this low rent for another 5 years. So really important that you guys check the lease, and I'm going to go through a couple of examples with you guys in a second. Make sure that in the lease there's no cap, there's no collar. If there's a ratchet, great, and understand what triggers the market review. So I'll explain that in a second. So here's just an example of how the market review works. So let's say there's a lease with 4% fixed annual review, and there's a market review at year 6. Then you start off at 100K. Year 2 will be 104 because it's 4% increase. Year 3 will be another 4% increase, etc., etc. And then there's a market review year 6, so rent's gone up by 10%. So that will be what the new lease rental going to be. Cool. Okay, so I've covered sort of the 4 sort of main things that you guys need to understand. I also now want to just talk about things to be aware of. So I talked about the ratchet clauses and the cap and the collar. The other thing you also need to be aware of and understand is what triggers a market review. Okay, in some leases, I guess the more standard leases is pretty straightforward. When the tenant exercises the option, it triggers a market review. However, there are some more complicated leases where a market review is triggered if a certain event happens. Let's say there's a rezoning that happens, or let's say the roof gets replaced, or maybe the landlord have created an extra 5 car parking spaces, or maybe the landlord has finished completing an awning. Like there's a number of different things that might trigger a market review. So those examples that I just given are pretty rare, but it's also important for you guys just to be aware of. Also understand what the market review mechanism is. Is it a valuation? Is it a what? So that's all going to be detailed in the lease. The other thing we also want to make sure is there a make good provision from the tenant, which means that when a tenant moves out, are they obliged to make good the premises? Now, most leases would have a make good clause. So the tenant, when they move out, they have to make good, as in basically whatever they put in, they're going to rip out. So if they put in a bunch of offices, they're going to rip it out, or they put in a bunch of equipment that's specific to their business, they're going to rip it out before they move out. Now, sometimes, for some reason, there's no make good clause in the lease. That means that the tenants have no responsibility to remove anything. So make good provision falls onto the landlord. So you as a landlord want to make sure that if there's no make good in the lease, you set aside a budget or a buffer so that you can potentially make good the premises later on. Last thing, really important, whether there's any unpaid incentives or any lessor responsibilities going forward. So, the example that I gave prior, let's say there's a tenant, they signed a lease, and the landlord is obliged to give them 12 months rent free. But you're looking at buying the property 6 months into the lease. That means there's 6 months of rent free period remaining. So you need to be aware of that, because there's 2 ways to do it. Either you cop it, so you buy the property as it is and you continue, providing the rent free for the next 6 months, or you, at settlement, you get the landlord to pay you out or pay the tenant out the remaining incentive. So if you don't catch that, or the lawyer doesn't catch that, and you settle on the property, oh my God, suddenly I've got 6 months worth of rent free I've got to carry. Like that's something that you don't want to do. And there's other landlord responsibilities as well that, might include like upgrading the air conditioning in year 5 or replacing the roof or like whatever it might be. Just be aware of what it is so that you can take it into consideration when you're assessing the property. Cool, makes sense? All right.
Will, can I just ask a question regarding the ratchet and cap and collar, please?
Mhm.
So are those clauses available on retail leases as well, or does it have to be in the commercial lease?
Yeah, usually in commercial leases. Each state's retail tenancy acts a little bit different. And the retail tenancy acts are usually written in a way that protects the tenant a little bit more than the landlord. So it's similar to a residential tenancy act. I know in New South Wales, I think you're not allowed to have a cap and collar. But things might have changed. So I'm not 100% across that.
Thank
you. Yeah. Let me come back to you on that. Okay, cool. All right. So anyway, so we've covered off some of the major sort of principles. So I just want to talk to you guys about my very, very, very first commercial property deal. This is my deal. So back in 2006, I was 26 at the time. I went, you know what? I'm pretty smart. Maybe it's time for me to get into commercial. So at the time, I already had a few residential properties. So basically what it is this is a property in Lane Cove, if you guys know where it is. It's at 448 Pacific Highway. If you guys know where KFC is, it's a building next to KFC. If you guys are from Sydney, you guys would probably know that. So anyway, it's a little strata office, about 260 square meters. It's got a little bit of fit out. It's got a nice balcony at the back, and it's got like 7 car parking spaces, which is like, really, really, really awesome. So at the time, when I was looking at properties to buy, I saw this property, but at the time, I think the asking price was 850,000. So nah, this is too expensive. So I didn't buy anything for 6 months, and I saw the property was still available, and it was still advertised at 850. So I contacted the agent and said, "Hey, look, what does the vendor want to do? Does he want to sell? Like 850 is not, moving the needle." And eventually negotiated down to $750,000. At the time, the tenant was about to move out, so I was actually inheriting basically vacant possession. So the tenant had like 2 months left on the lease, and they were moving out. And that's one of the negotiating points that I used. I said, "Hey, look, tenant's about to move out. I need to drop the price by 100 grand." So anyway, bought the property at the end of 2026. I think it took 5 months to lease out this one. I can't remember exactly, but it took a little bit longer than I expected, to be honest. And eventually I leased it. I think I leased it for $90,000 gross. The previous tenant was only paying about $70,000 gross, and I leased it out for $90,000 gross. But I artificially increased the face rent by offering the incoming tenant a huge incentive. I think at the time I offered, I think it was about 15 or 16% incentive. So I held on to the property, and unfortunately the GFC was kind of like just around the corner. So that kind of softened the market a little bit. So I had to hold on to the property a little bit longer. And eventually I sold 3.5 years later for a tiny profit. So I sold it for $915,000. So I think I netted like 100 grand or maybe a little bit more. I can't remember exactly. If I had sold it before the GFC, which I was intending to do, I think I would have made more. But anyway, that's my first little deal, how I use a rental reversion strategy. So this strategy, you can apply to any price range. You can apply to $500,000 properties, $5 million properties, $50 million properties. That's the beauty of it. Was the incentive in rent-free or fit out? It was in rent-free. Yeah, it was in rent-free. Okay. here's another case study I want to walk through, which is one of the bigger deals. So we secured this deal on behalf of one of our clients last year, and it's a warehouse estate in Brisbane, in Wacol, a place called Wacol. So it's basically 3 warehouses together. It was a great deal, and I'll run you through the numbers in a second. But basically, the acquisition price was $9,280,000. Huge land, almost 13,000 square meters. The 3 building combined is about 4,755 square meters. It has 3 years remaining in the lease, and is leased to a company called Resitech, and they're a multinational company, so a really good, high quality tenant. They've been in the building for about 20 years already. There are 3 years remaining, but no options. And they're paying under market rent. I'm going to show you the numbers in a second. And the initial years were just shy of 6%. So we thought this was pretty good, because the rents that they're paying about 40% under market rent. So let me see if I can find this. Sorry, guys, I had it saved somewhere. And I want to run through the numbers with you guys right now, so you guys understand how we analyzed and how we packaged this deal together. Okay, so can everyone see the spreadsheet? Yep. Okay. So you guys saw a sample of this during session 1, but I'll run through it again with this particular property. So top line here is the subject property. These are the parameters that I mentioned. Had an original asking price of 10 million. But what we were looking at is basically what the current rent is. So the tenant paying 537,000, which translated to a net rent per square meter of $113. So based on our research and experience, we knew that this was under market rent. So what we did was we gathered as much intel as we could. To be honest, there wasn't a lot of deals done in that size. So, 1,000, 2,000, 3,000 square meter transactions were few and far between. But we still managed to get enough evidence to formulate a view on, what the property should be worth in the rental market. So you can see all these properties, with the exception of a couple, were all getting $150, $160 per square meter. We also looked at a bunch of sales evidence, what properties have been transacting at the time. So this data is from last year. So some of these numbers are not relevant today, but again, it gave us enough information to formulate a view on what the market rent and market price should be for a property like this. So what we did afterwards is we adopted what we believed is the market rent, price per square meter of land, and price per square meter of build. So we're very confident that the market rent at the time of purchase is somewhere between $150 to $160 per square meter net. And the reason for that is this particular property has a very special zoning, which allows 24-hour operation. So the factory that's in there at the moment, they do plastic recycling. They run 24/7. And that's a really rare zoning. You don't get it very often. So we knew that if these guys moved out, we can lease the property in a heartbeat to another company that's probably going to pay $150, $160 per square meter. So then we also adopted $1,000 to $1,200 per square meter of land and $2,000, $2,500 per square meter of build for a building like this. So then we looked at the feasibility, and this is how we do it. We look at the the asking price, and we look at, all right, what does that translate per square meter of land? Is that within the market range or below the market range? It's below the market range. So that's good news. And what about the price per square meter of build? It's on the lower range, which is also good for us. So we ended up doing a deal at 928, which basically gave us an outcome, which is what we believe was below the market range. So which is good. So we're buying this property at below market range. So what's the strategy here? Like, how does it work? How do we get the uplift? What can we expect? So as you can see, there's 3 buildings, 3 tenants. Well, so 1 tenant, 3 buildings, but the lease expires in December 2026. There's no options. That's the current rent, and this is the current market rent as at 2023. However, we've projected a little bit of growth. Because if you look at a lot of the studies, and guys, this is a quick tip. If you guys want, good data, go to CBRE's website, cbre.com.au, and you can download a lot of their research reports for free. So CBRE has good report. JOL also has good report as well. And Urbis also has good reports as well, but I think you need to pay for the Urbis reports. So obviously, we read a bunch of reports, a bunch of stuff, and then we are predicting that the industrial property market in Brisbane will continue to grow. The rents probably continue to grow by double digits, probably for the next 3 to 4 years. So conservatively, at the end of 2026, we're expecting rents to be at least $180 to $210 per square meter. So if we use the same cap rate of what we bought it for, and we apply a rental reversion at the end of 2026, the rent should be at around $930,000. And the valuation of property should sit around $15.6 million. Okay, so do you guys see how the cap rate comes into play now? Now, we also look at cap rates on a couple of scenarios. So obviously, 6% is what we believe is going to be the cap rate in a few years' time, but maybe the cap rate softens a little bit. So even as cap rate softens a little bit to 6.5, the valuation of the property is probably going to be around $14.5 million. So what does that all mean? So this is where the feasibility comes in. And guys, feel free to jump in with questions. So assuming we fast forward to the end of 2006, we've reached out to Residtech and we go, hey guys, your lease is up. We need to increase your rent because rent's gone up. It's not $12 a square meter anymore. It's like $200 a square meter now. What do you guys want to do? Do you guys want to stay or not? Now, our anticipation is that they're going to stay because given the size of their operation and the demand for power and the fact that they need to operate 24/7, we feel like they probably don't want to leave. They're probably going to stay because they already stayed 20 years prior to that. So I think there's more than 50% chance they're going to stay. However, this is very important, guys. The feasibility, we always base it on the assumption that the tenant's going to move out. Okay, never assume the tenant will stay. So on that note, we factored in how long we feel it's going to lease the property out, how much it's going to cost in terms of leasing fees, incentives, interest payments, etc. And we've come up with this feasibility. So I'll explain this bit by bit. Yeah, excuse me. Okay, so the first part is the acquisition. So that's the price that we paid for it. That's the stamp duty paid for it. That's the closing costs like legal fees, building inspections, etc. That's consulting costs. So all up about $10 million was the total acquisition cost for that particular property. Now, we're assuming the tenant's going to move out, which means we're going to have to market the property and lease out the property. So we'll have to appoint some leasing agents to lease out the property. So the leasing agent is probably going to charge around 13% leasing fees. That's kind of the standard rate. And they'll charge it on 30% of the annual rent. So 121,000 is 30% of the annual rent. So that's what we're expecting to pay. Incentives. So in the Brisbane market at the moment, incentives are at around that 10% level. So if a new tenant comes in and they're going to sign a new 5-year lease, we'll probably need to give them 10% incentive, and that's what that works out to be. So it's basically annual rent times 5 years times 10%. So about $468,000. So that's going to be holding costs, obviously. So interest payments. So you as the landlord, unless you're paying cash for it, you're going to borrow some money from the bank and you're going to be paying interest. So that's 3 years worth of interest payments. And the good thing is you are collecting rent for the next 3 years because these guys could have 3 years left in the lease. So you'll be collecting at least $1.66 million in rent. So that can offset some of these costs. And there might be a 6 months vacancy period in between tenants, which means you got to pay for outgoings during those 6 months. So the total leasing campaign is going to cost probably around $193,000. So the total project cost is about $10,224,000. If we base it on a new valuation of $15.6 million, there's a net profit of $5.4 million. So that's about 52% uplift in 3 years. Now, in the event that our assumption is correct, that the tenant will stay, then basically like this falls away. Like we'll save ourselves, I don't know, a lot of money. We'll save ourselves at least, I think, 500, 600 grand. So that becomes 6 million. Last tab. This is just a quick cash flow. I won't go into very detail here, but basically, we're assuming 60% LVR on this property. So it's $4.6 million of cash is required to buy the property, and that's the cash flow that you can expect going forward for the next sort of 10 years. Cool. Any questions on this one?
So when you're negotiating with the tenant, is this something that you would start the moment that you purchase, or is this something that you would do closer to when their lease expires?
Depends. So in the case of this property, we'll probably wait to the end because timing is really important. These guys got 3 years left. If we go to them, hey, do you want to stay? We're going to jack your rent up. You're essentially giving them 3 years time to find a place to relocate. So you're giving them too much reaction time. You kind of, for lack of a better phrase, you kind of want to corner them a little bit. So you might start this conversation maybe 6 or 9 months prior to their lease expiry, and they might actually come to you. They might actually come to you and say, hey, look, we really want to stay beyond the next 3 years. We're happy to sign a brand new 10-year lease now. Right? So that's great. So in the case of Club Lime, that's exactly what happened. Because Club Lime had 2 years remaining in their lease. But once we secured the property, they just came to us and said, hey, look, we want to stay long-term. Can we start the lease negotiation now and bring forward this discussion? And we said, yeah, we're all for it. Yeah. So you kind of have to assess on a case-by-case scenario. If there's an advantage to delay the conversation, you take it. If there's advantage to bring the conversation forward, you do that as well.
Question about the if you go back to the project feasibility one, The leasing costs, is that 13% off the first year's rent, or is that off the total rent that you get over the leasing, the lease term?
Yeah. First year's rent.
First year.
The first year's.
If the existing tenant was to stay on, do they usually try and negotiate incentives as well to with the lease renewal?
Oh, I would say they will try. Yeah, right. They'll always try, but whether or not they get it in the end, or whether or not you grant it at the end, like that's a different story.
Yeah. Okay.
Yeah.
Cool.
In terms of the projected square meter rate that you've applied for from a leasing perspective, in 2026, how did you derive that?
Yeah. So in most feasibilities, we sometimes ignore it because we only want to count what we can bank on. But to explain how we got to this number is based on the reports and the research that we've read from Saville, CBRE, Jones Lang LaSalle, and also sort of our feel for the market. We're anticipating a double-digit rental growth every year in this market for the next 3 to 4 years. So if the current market rent is 150 already, and we apply just 10% increase per annum over the next 3 years, we would arrive at this figure. Well, actually more higher than this figure.
Yeah. Cool.
Okay. All right. Cool. That's
I've got a question,
yeah.
another question, sorry, about the cap rates and things, because I guess over time, things may change, and if there's different amounts of yield compression and things like that, like how can we be so sure, like in the future that's what the cap rate's going to be, or do you sort of assume it on today's cap rate going forward?
That's a really good question. So notwithstanding what happened in COVID, because that was a bit of an anomaly, you'll find that cap rates, unless there is a massive trigger, you probably don't see cap rates jump or fall too much. However, we kind of look at what the current cap rate is, and then we apply a range. So in this instance, cap rate 6%, and we applied a range. So if the cap rate sharpens to 5.5, like that's even better, right? Because the price is going to go up. But we're saying, well, today's cap rate is 6%, so let's just cap the best case scenario at 6%, and maybe the worst case scenario is 6.5%. So we kind of built that in a little bit. So even if we're a little bit more bearish about it, and then we say maybe it's 6.75, like maybe that's the worst case scenario, which is still, you're still, 3-4 million dollars ahead.
Yeah. Okay. How much, like, for example, if it's, in an area that there's a lot more, say, green fields, and is that usually taken into account with the valuations as well? Does that affect the cap rate and things? If they could just build another sort of industrial site in this case, not too far away.
I mean, possibly. Yeah, you have to consider that as well. But you got to also understand the economics of building a new facility. The developers will also look at what cap rates are, so that they can factor in, what the gross realization is at the end of the construction. So they're not going to go ahead and build something they're going to lose money. Yeah. So as a matter of fact, they'll build something that's probably going to be priced higher than established properties.
Right. Okay.
Yeah. So they're still playing the same rules as us. They're going to still work out what the cap rate is and how that's going to apply to their model, and what is eventually is going to be, the gross realization, the end value of the property.
Yeah.
Yeah.
Thank you.
No worries. Okay.
Will,
Yep.
just in regards to market review, during the market review event, especially when the rental reversion is quite significant at that 30-40%, is there an actual process, like a formal process that we would go through, such as obtaining valuation reports to assist with the discussion, or is it just gathering, market evidence would be sufficient?
Yeah, good questions. I'm actually going to cover that in later slides. But to quickly answer the question, is I try to avoid valuation, but that's the standard practice anyway. So in every commercial lease, you'll see that if the two parties can't come to agreement for the rental reversion, then an independent valuer is appointed. I try my very best to avoid that, because valuation is not a real science, in Australia particularly. And hopefully there's no valuers here, but like I've seen valuers do ridiculous things. Like if they're having a bad day and they want to take it out on someone, they'll take it out on your property. Yeah. But to answer your question, yeah, you obviously try to gather as much evidence and intel as you can, so you can present your case, and the tenant will probably do the same thing, and then you guys just try to negotiate. It's another round of negotiation. But if both parties can't agree, then the function that's built into the lease is that an independent valuer is appointed. So I'll share some tips in a moment on how to do that efficiently. But we'll move on. Who wants to do a deal like this? Yeah, I'm sure you guys want to do that. Mindful of time, so I'm just going to keep going. Okay, so we've looked at one case study and a couple of other things. So what are we really looking for in a deal? So the question now you guys probably want to ask is, like, how do I find deals like this? How do I find deals? What am I looking for? So here are a few things. We're looking for assets with existing leases. Now, I'm talking strictly about rental reversion. Okay, so I'm not talking about any other strategy at the moment. Yes, there could be properties where there is half vacancy that could still use rental reversion, but strictly speaking, just for rental reversion, we'll leave all the other strategies aside. We're looking for assets with existing leases. And we want to look at assets with existing leases where the rental is misaligned with the market. And what that basically means is, because the tenant's paying a lower rent, it's putting a downward pressure on the value of the property because of the cap rate method evaluation and all that type of stuff. We also want to look at properties that are short WALE, because what's the point of buying a property that's under rented but there's got 10 years remaining on the lease, right? You can't exercise the rental reversion for 10 years. So you're looking for something for a short WALE, 1 year, 2 year, 3 years, depending on your appetite and the profit margin, maybe even up to 4 years. And obviously you want to be able to calculate a good profit margin out of it. And the other thing is, you want to make sure you find a property that's going to meet funding requirements, because if you can't fund the property, you can't buy it. So talk about funding. You've got your traditional funding methods, your full docs and things like that. But I want to talk about the lease doc a little bit here. I just want to see who's familiar with lease doc. Okay, great, a few of you. Okay, I'll quickly explain what a lease doc means. So with residential properties, they're basically 2 or 3 different ways. You go the full doc, where you have to provide all your tax statements and your income statement, your asset and liabilities, your left liver and your right kidney, right? That's how you get the full doc. And then you've got the low doc and you've got a no doc. Commercial property is the same. They still have the full doc, low doc, no doc, but then they have this one here, which is really amazing, which is a lease doc loan. So lease doc loan, the lender assesses the serviceability on the asset only. So they don't look at your income statement, they don't look at your tax returns, they don't look at anything about you. So it's only what is the asset producing on a way of income, and they use that rental income to assess the serviceability. Depending on the lender, you can borrow up to 70% LVR, but the lower the LVR bracket, the better the interest rate is. The lease term that they'll offer you is tied in to the WALE. So if your property has a 3-year WALE, let's say, then the maximum lease loan term, beg your pardon, will be 3 years, because a lease doc is tied in with the lease. The rates are actually pretty similar to a full doc, so it's actually pretty competitive. There's probably like, from what I've seen, it's probably like no more than 0.5% difference in interest rates, which is pretty good. And typically lenders need a income coverage of 1.3 to 1.5, depending on lender. So basically what that means is, for every dollar that you need to use for servicing, you need to have an income that's 1.3 to 1.4 above that. And I explain how that works in a second. So that's what I mean. So the full doc loan is really good for investors who've got capital, who doesn't have serviceability, like business owners who don't declare a lot of income, or people who are retired, or just sophisticated investors, syndicates. This is how commercial property investors jump from one property to the next, because there is no lending ceiling. So in terms of how this lease doc is calculated, so the quickest way to work out how much of the money you can borrow on a property is to look at what the net rent is, divided by the income coverage, and then divided by the interest rate. So using this example, let's say you found a warehouse or a shop that's currently paying $100,000 in net rent. You divide that by 1.5, which is the income coverage required by the lender. Some lenders are 1.3, some are 1.5, I think some are 1.7, depending on who you go to, but on average 1.5. And you divide it by the interest rate. At the moment, it's roughly about 6.85 or 7%, if you will. And that equals to $973,000. So that's the maximum loan amount that you can get for this property that's paying you this amount of rent. I'll give you another example. So let's say you've found a row of shops. There's 6 shops. One of them is vacant, but it's 5 tenants. And each tenant is paying you $10,000 in rent. So that means your current rent is $50,000. Then how do you work out how much money can I borrow? You divide it by the income coverage of 1.5. So that's the amount of income that the banks are going to use to calculate how much you can pay, to calculate your serviceability, beg your pardon. And then divided by the interest rate. So that's $486,000. That's the maximum loan that you can borrow for that property at that point in time. Now, let's say you are fortunate enough to lease out the vacant shop for $10,000 as well. So all of a sudden, you've got $60,000 of income coming in. Now, maybe your maximum loan has increased, because now you go back to the bank and say, hey, I've got an extra $10,000 coming in now. What can I borrow? Now, all of a sudden, your maximum loan amount jumps up to $583,000. Okay, so you've gone from 486 to 583, so almost 100 grand in increase in max loan. Make sense? Okay, so this is probably the easiest way to fund a property with the rental reversion sort of strategy. It's very easy, very simple, very straightforward. Obviously, if you personally have good serviceability because you've got really good income, you've got a really high paying job or whatever, maybe it makes sense for you to go for a full doc loan, because ultimately the interest rate's going to be a little bit better and every cent counts. But if not, your fallback would be a lease doc loan. Cool. Case study 2, quick one. Sorry, is it common to extract equity to purchase another? Yes, absolutely. I'll talk about the exit strategy in a second. You're absolutely. It depends on what you want to do as well. If you want to just continue paying down a debt, then you don't need to. So I'm just replying to Rusty's question on the chat room. So the question is it common to extract equity to purchase another property? Depends on what you want to do. So if you want to grow your portfolio quickly, then yes, as soon as you've increased the value of the property, refinance, get your capital back, and then go again. Or if you're like, hey, you know what, I just want to flip the property, then you might as well just flip the property, or you might say, you know what, I just want to pay down the debt. Completely up to you. Quick one, case study number 2. There's a little warehouse in Westborough, Melbourne. Good little warehouse leased to F45, $1 million acquisition. Site area 639 to 638, net lettable area 465, had 0.5 years remaining on the lease, with an initial yield of 3.8. So very low initial yield, but the upside is really good for a property like this. And I'll show you very quickly what it looks like. Where is it? Oh, there you go. Sorry, guys, Sorry, I just lost it for a second. Let me come back to this. Okay. Really similar thing. So we looked at the property. So you guys can see the spreadsheet? Yes? Okay, cool. So same thing. We assessed the property, we looked at it, and then we saw that the passing rent is $82 per square meter. We knew immediately it was under rented. Original asking price was 1.2, which was like, forget it, not going to pay that, but that's fine. Let's have a look at what the leasing evidence suggests. So we looked at a bunch of these properties, and we can tell that the property is definitely under rented. Like it's clear as day. We also then looked at obviously the sales evidence to formulate a view on what it's worth. And very quickly, this is what we've adopted. So $140 to $150 per square meter. And so we offered $1 million, bought it for $1 million. So current rent 38, the new rent's going to be 69,000. And based on the same cap, based on the adopted cap rate of 5%, which is what we feel the property would be. That's the new valuation. And after all your acquisition costs and so forth, you're about 300 grand in front. And this one is done immediately. So not like the one in Wakehall, we have to wait 3 years for the rental reversion. This one is done in a matter of a few months. Any questions on this? Pretty straightforward.
What were some of the things that you used in negotiating the price down to 1 mil?
It was mainly just funding, right? Because we just basically said, look, you're not going to get 1.2 million because no one's going to be able to fund it. At $38,000 in rent, using that lease stock calculation, right? The maximum loan you're going to get, and this is basically what we said to the agent, like the maximum loan you're going to get is like 360.
I'm doing a conference call tonight. How long do I have to call you back?
Yeah. So we're like, look, no one in the right mind is going to buy the property of 1.2 million if nobody can fund the property. So obviously for this property, you're not going to use a lease doc loan because it doesn't make sense. You'll go for a full doc loan for this type of property. Yeah. So I think most professionals, with a good income can borrow like $1 million. And that's what we use. And we chipped away. We first started at 850 grand, and then we chipped away into $1 million. Tim has a question in the chat room, guys. So Tim is asking, how do you get the bank to give you valuation putting in extra tenant if you haven't settled on the property yet? Well, you can call for an evaluation at any time. So a lot of the times, particularly if you have a property that's got a slightly delayed settlement, and you know that you're only like 2 weeks away from signing up a new tenant, then what you could do is you would wait for that new lease to be signed before you order a valuation. So it gets done all the time. So maybe you had a valuation from day one, and then maybe a month later, there's a new tenant that's come in, and this is still within the settlement period. You can order another valuation. Obviously, it's going to cost you probably another like 3, 4, 5 grand, depending on what it is. But it might be worth it because you've signed a new lease now, and you can borrow another extra $100,000. You might as well pay that extra 3, 4, 5 grand for another valuation. So you can do it. You just have to ask the bank and pay. Cool. Okay, moving on. Where did my presser go? Okay, here we go. Okay, so I've showed you guys a few case studies. Now I want to get into the nitty-gritties. So I hope by now you guys understand how the rental reversion works, how the feasibility works. It's probably one of the quickest strategies to adopt. This rental reversion strategy is also the lowest risk. So basically, in principle, what you're looking for is a property that's under rented. But you want to make sure that it's under rented enough to still give you a good profit margin. Now, if you guys recall in session 1, I said that triaging properties is very important because you want to be able to get through as many opportunities as possible because it's going to take you 1,000 properties to get the one that you want. So how do I triage with rental reversion in mind? So as I mentioned earlier, this is what we're looking for. We're looking for assets that's got existing lease in place, that is under rented, so it's putting downward pressure on the value. Something that's got a short WALE, 1 year, 2 years, 3 years, maybe 4 years max if it's a really compelling opportunity. You want to make sure that's got a good profit margin and it meets funding requirements. This is how I do a back of an envelope assessment on it. Okay, so let's assume I found an opportunity. I know what the market rent is. Then what I do is then I figure out, all right, well, how much can I pay for it? So let's say I found a property, and if I adopt a market review today, if I was able to adopt a market review today, and based on the current cap rate, the property should be worth 2 million. I start with that. I start with what the end value might be. And then I say to myself, well, how much profit do I want? Do I want 10%? Do I want 15%? Do I want 20% profit margin? Let's go with 20%. So then I divide it by 120% because I want 20% profit margin. Oops, sorry, I stopped that up. Let me try again. Divide by 1.2. So 166,666,666 is going to be the maximum project cost I'm willing to take. So how does that then translate into purchasing cost? Well, you guys remember there's things like stamp duty, you've got your due diligence costs, you've got some consulting costs, and you've got some leasing costs. So stamp duty, depending on how much the property is anywhere between 5 to 6%. And then you've got closing costs, probably about 2%. So it's 8% already. And then you've got your leasing costs and things like that. So that could be another 4%. So then what I do then is I then divide that again by 1.12, which is 112%, which is 100% of it is the purchase price. And then I'm counting for stamp duty, closing costs, and leasing costs. That is the price that I'm able to pay for the property. So that's my back of the envelope calculation. Make sense? Cool. Okay. I hope I've got enough time to run through a couple of things. So I want to give you guys a bit of a demonstration on how I actually look for stuff. So I'm going to have this on the side here. Okay. All right. This is what we're looking for. Okay. So I'll go on to realcommercial.com.au. I'll go into commercialrealestate.com.au, and then I'll type in the places that I want to look at. So we ran through this exercise in session 1, so I'm not going to go through explaining how to do all this, but this is how I quickly triage. I type in the parameters I want to look at, and the first thing I'm doing is I'm eliminating 2 things. I'm eliminating ads that says brand new 10-year lease. I'm not looking at that. And then the other thing I'm looking at is I'm eliminating is vacant possession. Now, don't get me wrong, sometimes you can get a good deal with vacant possession. But that's for other strategies. For rental reversion strategy, just strictly speaking about rental reversion strategy, I'm eliminating brand new 10-year leases or vacant possession. Okay, so I can quickly go down this. So I go, oh, I don't know what this is, so maybe I'll put it aside. Value add. Oh, okay, that's interesting. By the way, this is live, so maybe you guys can pick up a couple of deals as we're doing this. What is this? Not sure. So let's have a look. Freestander. I don't know. Sometimes I wish some of these ads have more information. Okay, that doesn't say anything. Tenanted tilt slab. Okay, maybe that's interesting. That's a development site, so it's no. I don't even know what that is. Let's just have a look. I don't know what that is. Let's have a look. What is this? I don't know. Let's have a look. Okay. So obviously I didn't tighten my parameters. I should have tightened up by price. But anyway, so I went through page 1 very quickly. I took like 45 seconds. And then I'll go into these tabs and I read the description. Okay, tenanted investment. Let's have a look. What does it say? Blah, 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 blah. Okay. 3.5 years remaining. Leased until October 27. A little bit longer than I like. So, no, sorry. Pass. Next one. So I've just triaged that property. You got it? Next one. Let's have a look. Doesn't have a lot of information. Doesn't tell me the rent, doesn't tell me, the tenancy schedule. Or maybe I need to contact the tenant for this one. So I might just type an inquiry. Like, hey, can you send me the information memorandum? So again, we went through this in session 1, so I'm not going to go through it again. I guess have a look at this one. Let's go for this one says vacant possession. Now, a lot of times, just be mindful that the agents or the secretaries that are uploading it, they forget to tick this box. So this could be wrong. That's why I always look at the description. Okay, so here we go. Lease until August 2024. Oh, which is only like 4 months away. That's interesting. But it doesn't say what the rent is. So let's find out. Okay, so let's make an inquiry. Hey, can you please confirm the rent, send me an IM, send me a copy of the lease. This one again, let's have a look. Holding income on a month-to-month basis. Okay, this is almost the same as vacant possession. Because an owner-occupier can come in and go, you know what, I just buy and occupy myself. So you're not going to be as competitive as an owner-occupier. So I will probably discount this. This one, that looks interesting. It says vacant possession, but is it? I don't know, maybe it is. Yeah, maybe I'll contact the agent. Leave an inquiry. Go for the same thing. Oh, here we go. Brand new 3-year lease to 2026. So that's 2.5 years remaining. Maybe I'll look at it. What's the rent? 45,000 plus GST. It doesn't say if it's net or gross rent, which is annoying. So what does that work out on a rate per square meter? What's the size? 351. Okay, so it's 45,000 divided by 351. That's $128 per square meter. If this was a gross rent, then it's under rented. I can tell you guys straight away. If this is a net rent, then it's on the lower range of market. I'm telling you this because I know the market. So hopefully you guys get to a point where you guys just eyeball the information like me and know exactly, yep, this is under rented, this is not under rented. So this is a question mark. So we just need clarity. Is it a gross rent or a net rent? So let's contact the agent. It's the same agent, I think. Oh, same company. Okay, this one, next one, partially. Okay, maybe it's half vacant. Newly refurbished. Oh, okay, newly refurbished. I don't want it. I typically don't want it because the upside's gone. But you know what? Let's have a look. Currently returning 645,000 with huge uplift. Really? What does that work out on a rate per square meter? Let's have a look. 645, 300 divided by 35. That's 181. I don't see the upside. Okay, so Rusty has asked, what is the typical difference on a percentage between gross and net? It depends on the asset type. So for warehouses in Brisbane, the typical outgoings are about $25 to $30 per square meter. So I guess for a place like this, that's like 25%. And if for office space, outgoings could be $80, $90 per square meter. So the percentage will be like 30%. Yeah. So hope that answers your question. Next one, let's have a look. Future high yielding investment. Long-standing tenant, 10 plus years, secured income until 2025. Oh, that's good. There's only 1 year left or 1.5 years left. Okay. It's got 6,259 square meters. I think it's under rented. Yeah. Sorry, guys. I think I'm going to buy this one. Divided by, what was it? 6,259. $56 per square meter. No way. No way. That's cheap. Something's going on. I think we found something, guys. Who's got, this is probably like, what would this be? This is probably like a $15, $16 million property. Do you guys want to like put all your money together and buy this one? So,
What's the uplift?
I don't know, but I tell you what, though, look at the ad. I think this is a really old ad. So what's happened here? So there's a disconnect, I think, between what's advertised to what might actually be the case. I'm not sure. This is interesting. But, you know, it's what the rent is, what, $53 per square meter. Rent here should be like at least $125 per square meter or 100. Yeah, so maybe it's a stale ad. I don't know. But it was last updated today. I don't know what's going on. So this is what I do. So I'll go, hi. Can I please have an IM? What's the price expectation? Why is EOI closing in November 2022? There you go. There you go, guys. Maybe, there you go. We found one. We found one. This one looks pretty promising. Okay, so let's see what the agent comes back with, and then finally we'll finish this one off. So this one's vacant. This is for lease and for sale. So no, we're not looking at this. Yeah. So cool. So guys, just a quick demonstration. So this little exercise took us maybe 6-7 minutes. So we kind of did like page one. So, and then, what I would typically do is I'll do kind of like the first 5 pages. And then maybe I'll move on to another property type or another location. And as I mentioned during the first session, if you spend 2 hours a day in the morning or in the afternoon just doing this, and you're sending those inquiries through at night, by the next morning, your inbox should be full. And then you can then start triaging those opportunities. So maybe if you've got like an hour and a half in the morning, an hour and a half at night, what you do is at nighttime, you make inquiries. In the morning, hopefully your inbox is full, and then in the morning you triage them. Going forward, now assuming, using that one which as an example, the one in Ipswich Road, let's say they come back and everything's like legit. Like, yeah, it is under rented, this, and that. Then we go, all right, well then the next step, what I usually do is I have a quick read of the lease. Because sometimes what's been advertised might not be consistent with the lease, or maybe there's something hidden in the lease. So I just want to quickly go through it. Now, I'm not a lawyer. I don't know if any of you guys are lawyers. So I'm not reading every single word of the lease. I'm just reading the key components of the lease. And these are the things that I'm looking for, these 5 things. Just confirming the rents are, checking whether there's a market review, a ratchet clause, any make good, and any unpaid incentives or landlord responsibilities. So what does a typical lease look like? Let me see if I can find it for you guys. I had it somewhere. Let's see, where's this lease that I was going to show you guys? Oh, okay. How about this one? Okay, so here's a typical lease. Yeah, typical lease. It's basically just a contract, and it's got a lot of these standard clauses. If you want to, you can read it word for word if you've got nothing else to do. But what I usually do is I go into the schedule first, because most of the stuff, excuse me, is summarized in the schedule. So I'm checking the numbers, I'm checking the rent. Okay, that seems consistent. Who's paying the outgoings? They're paying the outgoings. except for the land tax. So land tax is excluded. That's good to know. Because the land tax could be $5 grand, $6 grand, whatever it might be. So you need to factor it back into the calculation. Terms, okay, so got 2 further terms, and here are the trigger dates for the option. And here are the market review dates. Cool, we've checked it, excellent. So that ticks off. Special considerations, I would usually read in case there's something in there. But, you know, there's nothing out of the ordinary there. And then there's make good here. So where the lessee agrees to remove its goods at the end of the lease, the landlord will give in access. So some make good in there. So I'm not going to read this word for word today, but yep, there's a make good provision in there. Great. And then I'm going to go back to the rental review definition and see what the rental review calculation is. So have a quick read. Yeah, so standard. So basically it says valuation, landlord and tenant pays 50-50 of the valuation. The valuation will determine the rent as an expert, and it will take into consideration fixtures, fittings, blah, blah, blah. Yeah, so that's a pretty standard one. Okay, so I personally couldn't find anything weird about it. So yeah, so that's kind of what I usually do. I have a quick read of the lease and try to, like I said, try to identify these things. Now, obviously, when the deal gets serious, you're going to get a lawyer involved, and the lawyer will then go through the lease word for word and pick up any red flags and things like that you guys need to be aware of. Make sense so far? Okay. All right, so we're coming to sort of the pointy end of this now. This is like, okay, let's assume we've gone through 1,000 triages. We've done 100 assessments, analysis. We've looked at 10 properties. Now we've shortlisted 5 properties we want to put an offer on. Here are some things to consider. So during session 1, if you guys don't remember, you guys can watch a replay. I provided an offer template, you know, basically what are the essential terms. But for rental reversion, excuse me, strategy, these 4 things are probably the main levers or trigger points that you guys can use. There's more, obviously, and you guys can be as creative as you want. But these 4 generally the 4 that are the levers that you can pull. So let me explain how that all plays into the deal. Now, the deal would only work if all of these components work harmoniously. Because if it's too weighted on price and the settlement is too low or this and that, the deal is out of balance and ultimately you're going to lose money. So price obviously is really important because that's going to be a direct reflection of how much profit you're going to make. But then settlement is also going to affect the profit as well. So let me give you a couple of examples. So let's say there's a property that's $1 million. Using the F45 example. If we bought it for $1 million, we know that initially, before the rental reversion, we'll have to subsidize the mortgage payments because it's only giving us $38,000 in the beginning. And if we're borrowing 60%, the mortgage payments are probably going to be around $45,000. So we know, as a matter of fact, if we bought that property in the short term, we'll be subsidizing the mortgage. So how we can use settlement to work in our favor is say, you know what, let's let's go for a 6-month settlement. So during this 6 months, what's two things happening? One, you're not paying any interest to the bank. Number two, you're cutting the timeline down. And so until you get to the rental reversion date. And all you have to put up is maybe 5 or 10%. So you're saving, let's say we'll negotiate a 6 months delay settlement, you're potentially saving, in this example, maybe $5,000 of rental loan repayment. That's something, right? So obviously the bigger you get, when you do $10 million properties, that's gonna like turn out to be $500,000 of savings, right? So that's one way and one reason why you would use a delay settlement. And then on the contrary, if the seller is time sensitive and they need the money ASAP, maybe you go to them, you know what, I'll give you a short settlement. I'll settle in 2 weeks, but you have to give me a 20% discount on price. That might also work as well. So, I think last session I covered an opportunity that we did. We saved $200,000 because we were able to settle in 3 weeks, as opposed to the next buyer who needed, I think, 45 days to settle. So the seller took our deal instead because the seller could get the money faster. So they're happy to forego $200,000 to get the money faster than the other person. All right, so it's a balance, you see. Deposit. How do you play with deposit? Now, usually deposit's 5 or 10%. That's pretty standard. Now, depending on the seller's situation, again, going back to session one of the most important questions you can ask is, why is the seller selling? Can the deposit be used positively for the deal? As an example, let's use the example that I just made, right? So it was a $2.2 million property. If hypothetically we knew that the owner needed $500,000 to settle the next property, then maybe instead of saying, we'll pay 2.2 and settle in 3 weeks, maybe we'll say, like, give us a 6 months settlement, but we'll increase our deposit to 500,000, and then we'll release the deposit to you. Now that way, you've solved the seller's problem. Because don't forget, people are selling because they're trying to solve a problem. Whether it's a financial problem, whether it's a death in the family, whether it's in a divorce or like whatever, like people are only selling because they're trying to solve a problem. Why else would you sell? So you understand what the problem is, you can solve it. So another way of using a deposit is like that, right? Maybe you can release a deposit to them so they can deal with their problem elsewhere and da 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 da. And then number 4 is permission to market. So if you're buying a property where there's partial vacancy, obviously you want to try to fill that vacancy ASAP. You don't want to wait till settlement to do that, because a settlement might be 3 months later. Like a typical commercial property is maybe 60 to 90 day settlement, right? You don't want to wait 60 days, 90 days before you can start marketing the property. You want to start marketing the property straight away, so hopefully you can find a tenant to move in by the time you sell the property. So having the permission to market a property is very important and very beneficial for you as well, because you could save yourself 2 or 3 months of potential vacancy. And what does that translate to? Maybe that translates to 30 grand, 50 grand, 100 grand, depending on the size of the asset. So these 4 components are probably the main levers that you can use when you're negotiating a rental reversion strategy. Make sense? Questions? Last slide. Okay, so assuming everything goes well, you've found ideal property, you've secured the property, and you've waited a year now, and now it's time to do the rental reversion. So basically executing the rental reversion. As we explored earlier, typically there's a valuation component that's factored into the lease. So if both parties can't come to agreement, then an independent valuer is appointed, and the valuer would determine what the rent is. I always try to avoid it for reasons I've already stated. So this is kind of like the process that I would follow. So number one is I'll gather as much leasing evidence as possible that's going to support my case. So if I feel like the market rent is $200 per square meter, I'm going to find as much evidence as possible to support that this property type in this location of this size, of this quality should get $200 per square meter. I'm going to present it. So I'm going to use all that evidence, and I'm going to write the tenant a nice email or letter or whatever and say, hey, look, we appreciate you leasing the property for the last few years. We'd love for you to stay, but time has come to revisit your rent, and we believe that the current rent for this property should be $200 per square meter. And here's a bunch of leasing evidence to support that. And then they'll obviously then do their thing, and then they'll come back, and there's going to be a bit of to and fro. So you guys can then come to some sort of arrangement. Now, bear in mind what I talked about at the beginning of this session about incentives, about rental reviews. Wherever possible, keep the face rent as high as possible. Obviously within reason, because if the property is like $200 and you rent it out for $300, the valuer is going to pick it up on it. So you can definitely push the envelope a little bit, but obviously within reason. So definitely try to keep the face rent as high as possible and use the incentive as your tool for negotiation. And then point number 3 is, all right, so you kind of have to decide or discuss, do you then go into a brand new lease or you just do a lease extension? So in a case with Clubline, we did a brand new lease because the option period they had in the original lease was only 5 years, and we wanted them to do a 10-year lease. So we went into a new lease. In most cases, if someone's exercised the option, you just extend the lease, the current lease. It's cheaper, it's faster, it's easier. So yeah, that's a discussion you need to have with the tenant. And then you guys also need to look at it on a case-by-case scenario. Assuming you finalize the deal, then you can talk about an exit. So do you want to sell the property, or do you want to refinance the property and then go again with another property? And the final point is you can either DIY, so do it yourself, or you can appoint your property manager or leasing agent to do that. So it really comes down to how comfortable are you with having these sort of conversations. Okay, so there's no right or wrong. Like everyone's got their strengths and weaknesses. If you're not comfortable with negotiating, having these type of conversations, that's totally fine. You get your property manager to do it. You pay them obviously a fee for it, but obviously the result that you expect that they're going to deliver to you is going to be more than the fee that you're going to pay them, right? And it's sometimes, funny enough, like sometimes, like this is all like a relationship game as well. Like sometimes the agent who sold you the property might already have a really good relationship with the tenant, because maybe that agent put the tenant in there, right? So sometimes you might want to leverage that relationship. So rather than you going in there cold, like I'm the landlord and I want to increase your rent, like so you get friendly face in there, and sometimes doing that also helps as well. So there's less resistance, there's less friction. But completely up to you guys, obviously. So yeah, so any questions, guys? I don't think I covered everything about the executing of the rental reversion. But this is just a framework.
Yep. So I've got a question, Will. Where the point number 2, where you're talking about pushing the envelope in terms of trying to get the highest possible face rent as possible. Say, for example, if the market rental rate is $200 per square meter, and somehow the tenant agrees to, I don't know, 220. What's the likelihood that if you decide to sell or even revalue and refinance, what's the likelihood that the valuer will actually pick up on that and say, well, it's a bit high, it should actually be 200, and therefore bring down the value?
It could happen. Yeah, it could happen. So, how far can you push the envelope is is based on how you can justify it, right? So, there's a number of ways you can justify. Like, for example, things like we've looked around and there's no equivalent property. Like, this is a unique property for the tenant. Or it could also be you're looking at maybe you've done the deal today and then you're valuing it 6 months later, and then you might say, hey, look, there's been movement in the market already. Like, the market's gone up a little bit already. So obviously, if you're doing it, if the property's worth 200 and you're doing it 250, like, that's probably a little bit too much. Like, you probably push that too much, and the value's going to come back and bite you and go, no, it's only 200. But if you're doing like 5-10%, a lot of times you get away with it. You just kind of have to justify it, and sometimes maybe that's where the incentives have to come in play as well. But I think, depending on your exit strategy as well, if you're looking to refinance and revalue the property, then the question that you've asked is extremely relevant. But if you're looking to sell the property, that question might be a little bit less relevant, because the valuer's probably not going to dig so deep into the rental. So, sorry, the value for the purchaser that's buying a property off you, yeah, is probably not going to dig so much into the rental. They're probably going to look at the property a little bit more.
Okay.
Yeah. So another way to look at it is I also like to look at what is the market range in that market. So if you look at, like, say, brand new properties in that market, maybe brand new properties are leasing for 250 a square meter. Whereas your property might be like an established property, maybe it's like 20 years old, right? And you're only leasing it for 200, 220. Then there's an argument that, hey, look, it's still within market range. Because it's a lack of supply, we're able to get 220. Now, if the brand new stock is leasing for 250 and then you've signed a lease for 260, then that clearly you've like exceeded the market range, and that's a really easy one to pick up. Yeah. So with these rental reversions strategies, obviously you're not going to be looking at brand new properties. You're going to look at established properties. So that's another way of kind of justifying the rental.
Yep.
Cool. Anyone else got any questions? Or want me to show you guys anything? Let's see. Tim's got a question regarding triage. How do you determine the location to start with? Do you start with macro population growth factor first? Okay, so yeah, so going back to what I talked about in session 1 is, let's run through this exercise first. So start with the end in mind. what do you want to achieve? How much capital have you got? That's a really important one. What's my ideal project duration, all that type of stuff. Once you've actually gone through this exercise, the question that you're asking in terms of like location, population, growth factors actually become very, very apparent. Because like, let's say you've got $500,000 cash. That's probably going to then dictate your buying capacity. So you'd probably be able to buy probably up to maybe $1.3, $1.5 million. Okay, so that's your cap, in terms of your purchasing cap. And then you say, oh, my profit target is like for my next deal, I want to be able to make $250,000. So that means you would have, if you can buy a property for 1.5, then you would want to sell it for like 1.8, 1.9 million dollars or $2 million. So that's a market range you want to have to play in. And then you kind of you look around, all right, well, what are the best asset types I can find in that price range? So if I look at Sydney as an example, if I've got $1 million, $1.5 million to spend, I'm probably not going to get a lot of opportunities, particularly like with good yields. Like you probably end up buying a strata somewhere, and it might only be giving you 4.5% yield. So you might go, all right, well then maybe Sydney's not the place for me. Maybe I've looked at regional. Maybe I look at Newcastle, or maybe I look at Toowoomba if I'm in Queensland. Maybe I'll look at Ipswich, Townsville. If I'm in Melbourne, maybe like Shepparton's pretty good. Your Bendigo is pretty good. Those type of places. So all those fundamental drivers or for the market, for the economy, like it's the same everywhere, whether you're doing resi or commercial property. So obviously you want to look at places that's got good infrastructure spending and population growth and really tight vacancy. Like that goes without saying. Those are like investing 101. But to determine what is going to suit you best, it's really important that you kind of like run through this exercise. Hope that makes sense. Beautiful. But to give you guys I guess a bit of a tip, Southeast Queensland is very good at the moment. A lot of people are investing there because it's affordable and the yields are pretty good. So maybe that's a good place to start. Flo's got a question. If someone is hoping to buy the first commercial property with SMSF, only has 200K, so but is it still worth looking at? Sure. Yeah, of course it's still worth looking at. But you'll be very limited to what you can buy. No, you could probably buy up to $500,000 in property. Maximum 500,000. No, maybe probably more like 400,000. So you kind of look around and say, all right, what can I buy for $400,000? It's probably not going to be a lot. Like you're probably definitely going to be buying strata. Maybe you can buy a strata shop or a strata warehouse in a slightly more regional area. That's going to give you good yield. But the fundamental still is the same, right? You want to find a deal. You want to find a good deal. I feel like if you went down the residential route, you're not going to find a deal at $400,000. Like you'll find a nice house in Adelaide or Perth for $400,000. That's going to give you, pretty good capital growth, but you're not going to be able to find a deal. If you look hard enough, you could probably still find like a good strata warehouse, shop, office for around $400,000 that's under rented. And you can still do the same rental reversion strategy with that. But I just think you have to look hard at that price range. Hopefully that helps. Lima's got a question. When looking at an unfamiliar location, how do you, I'm going to put it here. When looking at a unfamiliar location, how do you make yourself quickly familiar with the market rent to identify a rent misalignment? Okay, so I covered this in session 1. You just have to study. Sorry. You just have to study the market. So the more information memorandums you can collect, the more you can run your eyeballs through it, the more you'll be able to absorb. So let's say we're looking at Southeast Queensland. Okay, let's say we look at Brisbane as an example. Let's say we focus on just 5 locations in Brisbane. Let's pick places like Sumner or Coopers Plains or Tingalpa, or places in Ipswich. Let's just find 5 of these locations. Just start going through exactly what I demonstrated. Go on to Real Commercial and just start looking. And it's just collect IMs. The more you expose yourself to it, the more you can understand it. So it's definitely a numbers game, and you have to study. Yeah, sorry, there's no quick quick way. I mean, the other quick way. Sorry, there is one hack. There's one hack. I don't know whether you guys want to hear this, but it is one hack. Is you hire a buyer's agent. They'll have all the information for you. Yeah. Dan's got a question. No, RP data doesn't have rents. Yeah, sorry, team. RP data doesn't have rents. Commercial property rents is hardest to get because it's not. There's no platform that collects it. There's only one platform that I know of. It's called Cityscope. So Cityscope, City CITY Scope. They collect some, but they're not. Like their coverage is not comprehensive. They only cover like really like CBD and metro and major markets. But their subscription is very expensive too. I think they're like 20 grand a year, something like that. RBData doesn't have it. Dan's got a question. Any tips and tricks to find a net rent quickly before you ring the agent and find out the details in the area? So Dan, I'm assuming you mean how to find a net rent for a specific property?
Yeah, exactly. So yeah, sometimes they are net rent, sometimes they gross rent in the list of the property. Yeah. So is there any tips that you suggest to find out those information quickly on the web?
So I would say this. If you look at asset types, usually industrial properties are net rent. Usually, there are exceptions, and hopefully the ad description would say it. But if they don't, then sometimes you kind of have to work it out on per square meter rate. So the example that we looked at before, I think it was 45,000 per annum, but it worked out to be $128 per square meter. Now, to me, that sounds like a net rent because it's right because I know the area. So it sounds like it's a net rent because that's like right on the market rent. But if that per square meter rate works out to be 150, let's say, then I would reasonably assume that's a gross rent because it seems like it's $25 higher than what the market rent is for that location. But I think ultimately the best thing to do is just make the inquiry.
Okay. Yep. Thank you.
No worries. Cool. All right, guys. Any other questions? I know we've run over time a little bit, but I'm happy to stay another 5-10 minutes answering questions if you guys got any. While you guys are thinking about questions, just a quick reminder, our next session is in 2 weeks. So every fortnight. I think the next topic we are looking at, I think is the Strata subdivision. I think. I might be wrong. That's a really exciting one, by the way. That's my second favorite strategy. And I've got lots of examples I want to show you. Yeah. But cool. But any other questions on rental reversion? Flo's got a question. Is cap rate generally the same in the same suburb area? You said one of the factors is tenancy. What about between property types? How do you find cap rates of the property? Good question. So cap rates is very specific to property type and location. So as an example, you have cap rates for industrial properties, you have cap rates for retail properties, you have cap rates for offices. And then you have, and each location will be different. So the cap rate in Sydney will be different cap rate in Melbourne, and it will be different to Brisbane and Canberra and all that type of stuff. So it's almost like each segment or sub-segment of the market will have its own cap rate range. So when I was talking about factors that influence cap rate, I was talking about if you're comparing the same thing, like apple to apple, like if you're comparing the same shop in the same street, what are the things that would influence it? Obviously, the quality of the tenant, the WALE, and all that type of stuff. But yeah, but beyond that, the macro factors of cap rate will obviously be location and property type. And how do we find cap rate of a property? You got to ask the agents. Read the reports. Read the CBRE reports. Read the Jones Lang LaSalle reports. They're pretty good. Cool. Any other questions, guys? No worries. Okay, so I hope today's session was helpful. I know there's a lot to absorb. Once this video is ready, I'll send you guys the replay so you guys can rewatch this video. But just out of interest, guys, because I really want to make it really beneficial for you guys. Is there anything that you guys want to suggest about the way I'm presenting or the topics that I'm talking about or the way I'm presenting? Like if you guys got any suggestions or anything like that, like let me know. If you guys want to see more case studies or whatever, like, yeah, you guys let me know, okay? All right, brilliant. Okay, guys. Well, look, thanks for your time, guys. I had a blast. I don't feel sick anymore. I had a bit of a cold, maybe still a little bit, but yeah, after this session, I feel really good. So I hope you guys feel good as well. So a little bit of exercise for you guys, just so that you guys can understand this, is go and download 20 information memorandums. Just 20, not a lot. And just read through it. Pick maybe 2 locations. Do exactly the same thing as I demonstrated. Don't be shy. Go and ask for the IMs. And if the agents call you, just have a chat to them. Because it's a numbers game, and you got to go for 1,000 properties before you find a one.